Welcome back, guys. It's the Market Sniper, and we're going to do a precious metals update for you. Yep, that's right. Today, don't forget, do us a favor and smash the like, fool the algo, and get everybody on team. Share it as well. Pure currency for us. Sharing is caring. Okay, gold. So recent posts that we've made, we've had this one that was done 4 weeks ago. BlackRock is a criminal oligopoly, but we agree on one thing, that's gold. We were highlighting specifically during that video the gold euro market in actual fact. So you'll see that chart over there, gold euro. We were saying gold generally going to be up, and we were talking about the rising wedge. This was a squeeze point that we expected an upside move to take place. Many of you will be just dollar centric, even if you're not in America. So that's that point over there that you're going to break to the upside from around 1670s. You're at 1753. So that has indeed broken to the upside. Little transgender pippy there, that belongs over there where you popped. Okay, and we also spoke in previous videos on the gold silver ratio and why that was a shooting star, and the gold silver ratio was at 88.2 there, just below 90, and had run the 90. That's over there, and why we felt it was going to come off and sell off. So quite a lot of coverage that we've been doing in the precious metals space. Broadly, we've been well positioned for that. Let's take a look at where we are now with the mighty gold and silver. So as already alluded to, gold against the euro currency, it's against both currencies, and all the major currencies gold is overperforming. This is still very much in line with our expectations, which is a great move for the metals. Is likely to see it come to the other side up top here, I would imagine. So that red line, so we're on around the hourly, my apologies, the daily there. It's a much bigger time frame than many people expect, but we feel, and we said at the time, that you're going to squeeze higher. You're going to squeeze higher indeed. That was our overall opinion. Just tidy these charts up a tiny bit while we're at it. Yep. So that was the great move that we had predicted. By the way, coincided with the oil short. You were short, you were commodity neutral. Told you this many times, so I'll keep quiet now. Rally up to the red line is our next expectation before a down leg. Now we have to remind people that we have a number of takes on the rising wedges. They can also be downsides. In fact, that's the traditional technical analysis expectation. So this could be a level that ends up being run. We've spoken many times that there is an event that is likely to play out at some point that could be very disinflationary. And as a result, once you've gone up with an HVF, you then often squeeze higher with everyone chasing into the crowded trade. And then subsequently, even though you get up there, you have a major demand destroying event, which could coincide with the events that were March 2020, the needlecraft. So, you know, it could even be bigger. Now, commodities across the board are coming off, but not so much the monetized ones are precious metals. We've spoken on natural gas. Go see our natural gas video as a leader on the energies, which was the big play for Europe, etc., which is fizzling quite badly. So commodities are going to cool. There's definitely the rates hikes are going to bite now. So inflation will moderate, but it's not going to come back to super low levels unless we have a bank destroying event, which would see everybody lose their money. Then spending sure as hell will dry up, and you'll go full deflation. So that was the gold euro. We've also highlighted the gold pound. There's been clear levels. It's also very much an element of that grinding line and a little bit of a broadening. So for me, I'm still seeing a big deflationary event that will probably knock these prices, and this is still very much a cap in and around the 1575 for this. So this broadening structure here still probably going to have I'd expect it at one point to, on balance of probabilities, to run that basing ascending ground line to the downside before we get a true break. However, you can always be wrong on that. At the moment, we are feeling somewhat bullish, but we feel this event needs to happen. Thereafter, it's going to be exceedingly good. So remember, a view is always subject to the time frame that you're referring to in terms of its progress. So look, how do we be wrong on the deflationary event? You could come back and you could wind up here for a while and then you could go. But there's just a feeling generally when you've had a lot of money, these kind of steep grinds are typically function of a lot of scared money chasing in. Central banks have been big buyers as well. We're going to talk interestingly on the gold-silver ratio coming, so we'll be watching that. So this is what I'm going to be covering on the video, gold-silver ratio and the gold and silver markets specifically. And we're going to cap it at there. We've covered palladium versus platinum, which is moving in good order, maybe 1 minute just to give you a short update on the progress there. So this is your concern, and typically it's become gets to be a bit of a crowded trade, and what happens is the paper price gets slammed and it'll have a deeper effect than say that did on the events of 2020. So I fear for us in terms of demand driven events, people liquidate gold to get cash in an environment that you have disinflation, or when they are having to reduce margin in other places, etc., etc. Okay, so that's a little bit of gold against the other currencies. We haven't done gold JPY. Of course, yen had a period of some strength. Again, this was at its target. So you can see this move, that was an epic move, pure overperformance, and then you got another structure there. Look at that, squeezy, squeezy, Japanesey. Then it made its target just prior to the events. Perfect geometry. I mean, this is, you can't make this stuff up. You got your slam down post the target. This is what we call progress decay, opportunity to get in lower, sell at the target, get a chance to get in. Then you got a new wind up on the basis of the Japanese interest rates policies, which have been very eccentric, and now you find yourself back here. So again, a little bit churny and choppy here. This could indeed be something that might break to the downside for the first time, unless, as I say, in the event of a rush into the dollar, which is going to be a demand killing event. So we're going to have to watch those stocks. They're probably penciling in another half point for interest rate hikes in February. That could see March be the month where it gets a bit ropey, because things are going to break. Basically, they're going to tighten until they break. They're belligerent. I've done my Fed statement analysis. We have great resolve, belligerence. We are determined. Da 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 da. So they go. So they speak. So that's across all the other currencies. Let's have a look on the dollar. Very much a recovery bounce after a move. This typically falls into the category of a macro continuation pattern. It's been a big one. So, you know, that's how it looks from the lows here. Of course, that was an HVF as well that we called. And we also called the inverted head and shoulder with complexity. You want to learn how to do complex head and shoulders with us, you can pop over to themarketsniper.com, book a call. Don't forget to do that. Hit the like. You've just joined us. Hit the like, do the share. Puppy licks to the face. I'd appreciate it. We don't ask for any money. We don't run ads on the channel. That's all we ask. Do us a favor, and thank you to so many of you that are doing that. We get a great hit rate and we appreciate it for exactly that. So let's go over to the gold ratio. So here's the bit where I've been doing a little bit of extra draws. This is really new stuff, and you're not going to see this anywhere else that's done the dive. So this will be unique. Let's drop it down. So here you can see there's quite a lot going on. So there are a couple of things happening on this chart. It's quite deep and detailed. So we've done unbelievable gold and silver ratio analysis. I've got amazing other charts that does really long time frame and shows you why I actually think you could get to a single digit not just a 15 or a 20, a single digit in an extremity event on gold and silver ratio, which you can just only imagine what silver will be costing at that juncture line. But for now, I want to, I've done a different draw for you, and I want to talk about the macro. So the macro over here is big left shoulder. So let's just highlight this. So we're going to go TG pink and help overlay the draw here. Big left shoulder with a pullback down, you guessed it, for our first armpit at 65. So that blue line is actually 65 silver ounces to secure you 1 gold ounce. Can you believe you're not there? So remember, you're up at 88, you're up here when I was highlighting in the other YouTube that we expected that to trade down. You remember that? There we go. 88, just below the 90, shooting star through the 90, expectation come off down. We said it may go, if it topples, it might go all the way. It's not, I don't think it's going to actually do that. It's fallen quite a way from there, but now you're sitting at a ratio, gold silver ratio, in and around 77. So that's some way off the 90-88 mark. So since then, it's been very bullish for gold and silver, and the dollar's been a bit lame, which has helped. So this is the second visit down to the 65 mark. And this is, again, a very complex head and shoulder structure, grindy on the upside, blow off. We were the ones telling you up here at 113, you're almost certainly going to fail. We're also telling you on the shooting star, you're going to fall back a long way. That was when I think you got silver down at $11 again, which was exceptional. So down. We may also be doing a comparison between Russia and America on the commodities front, who produces what. So if you ignored GDP and you ignored services, what's actually happening on the commodities front between the two countries? Keep your eyes open. It'll be a very interesting one in terms of currencies, BRICS versus dollar, if that comes. So keep an earmark out. Don't forget to hit notify next to the subscribe button so that you don't miss that one when we put it out. Anyway, so the big macro red ones target will take you down to 32.8. That could see, you know, overperformance almost certainly beyond that, but that's an unbelievable spill from the 65. It would be nigh on half of the 65, just about as close as, damn it. You've got to ask yourself, well, what would gold's price and silver's price be in that environment? Because it'll be both bullish for gold and almost more so for silver. Now, don't forget, in 2011, silver hit $50 at gold silver price, but at the time, the gold price was, I think, at its highest point, only around 1900. So it has, in fact, gone beyond that more recently. So at a similar level, and I would imagine you would run that by a bit, you're probably going lower than that point there, or at least meeting it to the downside in the event of this macro head and shoulders performing. This still doesn't preclude the single digit run, which could be an absolute spiller. I mean, look at that absolute pump in the wrong direction, followed by the dump just in this one down leg. So that's head and shoulder number one. That's the macro I want to highlight. Now the left shoulder, just, I don't know my left from my right. We didn't change the word there. I cloned it. Let's edit. The right shoulder, the left and the right shoulder, thank you very much, let's go right shoulder, of this macro actually has its own structure. And this is where we were saying the 90 and the 88 is too high. You've actually only been through 90 about 3 times in history. Anyway, meaningful. It's a great time to get back into the precious metals. Since then, you've seen it fall down to the 77, and you've seen gold and silver both go up substantially, and silver more so. So let's drop into this right shoulder and show you what all this workings and drawings are all about over there. So we're going to let go of that, and we're going to go into the right shoulder. So the amazing things about fractals is you can often get the same structure many times over. So a little bit of dollar strength or a little bit of backing off on the metals would see us rise for a right shoulder. In fact, you're starting to get there a little bit. So now you need to look at the blue, little boy Pippi blue, our favorite color, especially with that cold water submersion that I'm doing there. It all gets very blue. Let's have a look. So up you go. Long period. This is an upside HVF that we called, by the way, which was bad news for metals, because this going up, obviously not good for the metals. Falling wedge, there you go, bump, return, move higher, target made on another HVF that those two structures were, turned out to be pretty much the top, marginally higher high, spilled through that funnel, and you've been non-stop back down, back to the blue, and you can see that there is a falling wedge here now. So this is going to, we've been predicting, you know, euro a little bit too strong, dollar being a bit too weak for too long. We've been predicting that at some point the dollar is going to reassert, and I think that moment's going to come. We're seeing the commodities coming off, with the natural gas being the leader there, and you can see you've got a number of impulses here inside of a falling wedge on this down leg, and now you're going up. Now actually silver hasn't done badly. Gold has just done a little better. So don't forget, the gold and silver ratio can still go up without the precious metals going down. It requires gold to go up more than silver. So let's just, before we continue with this chart, just show you the gold and silver prices, because that's also important. So whilst that has bumped to the upside, which is normally bearish, in actual fact it's not been particularly bearish yet, but that's still to come. So you're at 24,150. You see you had a bit of a run high there. You're looking a little bit gassed out. We were calling for this inverted head and shoulder to play out to 25. I'm not sure you fully made that target just yet. I might have to just check my numbers, because maybe it was just made and just missed, or you're still going to have another little rally one more time. But you can see that silver actually had a top around about Tuesday, 3rd of Jan. And since then it's been pulled back for 2 days before getting a slight rally, but it was rounding out. We were warning on our recent appearances in the number of the gold channels just to watch that. It's a little bit gassy, a little bit squeezing higher, whilst gold, as you can actually see, last 2 days it's been net up, and in fact is making a new localized high. So that's central bank buying a lot. So generally silver has done better over this period, the falling wedge. However, more recently, in the last handful of days, 3 or 4, gold is just sticking its head. So that points to more institutional and less retail. So retail is, you can see the difference, and that's again what we're seeing here in the gold silver ratio. The falling wedge, a little bit of a pop to the upside, but actually it's not been that bearish for precious metals. Normally the gold and silver ratio going up, it's not been that bearish. Gold is doing just dandy, and silver not bad. It's not as high as it was 3 or 4 days ago, but it's pulled back, having a little bit of an ease up. So it's pausing, and as a result they actually hold their own, and gold has actually gone higher broadly, despite this upward moves so far to the periphery of the macro falling wedge on what is a right shoulder in red for the super macro head and shoulders. That's the one that's running you down to 32.8, and is actually the head for this right shoulder. So that is the head. You can see there, I'm confusing the hell out of you, of course. That's the left shoulder, there's your head. That's what we're talking about in the blue. And my query or question to you all is, are we right shouldering now on a rally? And is that falling wedge bump that you're going to get out to the upside, which will probably have some form of return move and go for a little journey before coming back down? And when it comes back down, if it is to, on balance of probabilities, potentially, assuming no mega deflationary event that absolutely rug pulls both those, and of course silver being the higher beta, it pumps higher. So providing it doesn't run back up to the 95s, 96 levels, this falls into the category of a right shoulder. So let's examine that head and shoulder a little bit more. We've highlighted that there was a wedge. There was first a broadening structure on the way up that got broken to the downside, exactly as expected. At that point, return move, and you continue to fizzle down, and now you've made 2 blue armpits there, armpit 1 and 2, and we're highlighting the left shoulder upside HVF, head over here, falling wedge, bounce up, some form of structure. So we're getting ahead of ourselves. You haven't even had a full right shoulder yet, but I think you will push higher. Now when you push higher, that could come with more bearishness for the twos pricing, particularly on silver. but as I've already shown, in the early stages it's not been too bad, but I do feel it's a bit steamy. If silver gets across that $25 line for a short day or so, with a bit of help from gold going even higher, and low upper 1800s, 1880 to 1890, approaching 1900, then I think we could have both those come back down, and silver more so, and that will actually lead to this going higher. And that's exactly what, in a sense, we need for the head and shoulder. So initially things get worse. So this is why I talk about trading. Short term bad, medium term pretty good, long term excellent. So the fact of those different time frames is to give you a sense of what we're doing and what we're attempting to scenario cast. So if this overall right shoulder does a head and shoulder, you in effect have this structure. And we are in the rally phase, which is also suggested by the falling wedge. Okay, I think I've covered that. So what does that mean? What does that target mean? Well, you have a neckline that's in the blue. I've done it in the dark blue just so that it matches up. By the way, the amazing thing with HVF method, again, pop over to themarketsniper.com, learn how to utilize HVF method. It's just unbelievable. The key levels that continue to get suggested on smaller time frames with little HVFs. We've got a ton of funnels here, and guess where you came down to support, and guess where you supported now before bouncing. An absolute sway. 3 different HVF structures that have all given me funnels here that you have supported and not yet run. So for now you get that rally, but the break of those levels will be seminal. And if you do volume by price across this, which I tend to do only in premium areas, when you have unique take and implementation, you can find out more about that. Again, book a call, be part of that. You will find that these funnel levels are often clustered on areas where there is a high volume participation for that price level over a sustained period of zone. And you can look at the macro head and shoulder, and you can look at this head and shoulder, which is still on a big time frame in dailies. Big macro patterns give you clear long-term high probability setups, providing you patience. And we have a macro red head and shoulder, and we have a daily blue head and shoulder potential, but it might get worse first before a lot of these trigger. But if it does go up and over and comes back down, so if we get something like that, out, return, move, push higher, push higher, push higher, struggle on, lose momentum, come back down, something that will qualify as a right shoulder. I'd be a bit nervous if it was too high momentum and came similarly up there, then that no longer qualifies as well. It's a less good, even though if it doesn't run this high, it's a lower probability. So we don't want to see it lose its stuff, hence that warning on the demand. And it's very important. How do we be wrong on this, or how does our probability shift? How does our confidence get reduced? Ask always your question. How are we wrong with this? And what must happen for our probability or degree of confidence to get at least reduced, and at what level is it totally disqualified? I've told you when it's totally 100% off the table disqualified, and I've told you when the likelihood of my participation will be deeply reduced, roughly what would need to happen, and I've given you an idea of where I'd want it to turn for it to stay within the realms of acceptability. This is how you build the structure of a trade. So you can get in here with an exchange with longs on silver, for example, as you approach this, and if you push past a certain acceptable level on the gold silver ratio, you could get out on that. But the benefit on the downside could be so much more, because we're not even yet seeing that target. So let's have a look of the blue head and shoulder target. So its blue neckline is there. I'll just make it a tad fatter just for now. That's the smaller one. It's there, and that's your 65, which is down there. You can see that you would in fact end up triggering the bigger pattern, and this is what I call the fractal into macro pattern structures. When you trade multiple time frames in the same direction, you get to squeeze your risk on the smaller setup that has a much tighter stop, but though you get the rolling contagion of that move generating the new move, the probabilities aren't twice as difficult once you've already attained one probability going to the downside, and all you require is continuation for the next pattern on a bigger scale to continue that move. So that is where you get real excess jam. you know, and this is what we're all about. Big macro trades that we take right down to a lower time frame to squeeze risk to, so we can get fractals within bigger patterns within macro patterns across 3 time frames like that. It gives you real blow the doors off risk reward ratio. We are an RRR divided by time because we are breakouts. We want the job done quickly. We're conscious of carry cost and opportunity cost. So this is key principles that people don't have in their trading that are unique to HVF method. Again, I can't help but just get ranty about this because this is real belief systems. People are getting wrecked. Traders are getting wrecked. They don't know where to put stops all the time. I spent the first 30 years of my career stumbling around and finding, you know, thinking the markets absolutely hated me and brokers were just there to perfectly run my stops because I was doing all the obvious dumb things. I suddenly got luckier when I adhered to process and had an amazing system. I just became a luckier trader. Things tended to work out more. It was a real shift. That doesn't mean it just rained cash every day on me and I didn't have to do the work and I couldn't put a foot wrong. It just meant I felt luckier. I got luckier. It seemed I just got more breaks and it seemed less like people were doing stuff. The framing absolutely pivoted. And you will notice the same too as a student of HVF. So I'm going to take that neckline back down because it is actually the smaller head and shoulder. I just wanted to make sure it was apparent. So what do you do about this fact that you've got a target down there but another neckline for another structure here? Well, it gives you additional information on the likely flight curve, because what you'll probably end up doing is you get a right shoulder. If our scenario plays out, it doesn't have to, as I continue to assert, you'll get a 65 likely run and then you'll get a reaction again. And then you're likely to pivot and make target. So no journey is a straight line. I'd love for every trade you get in to just get a straight line capitulation if you're short in a straight line vertical. Doesn't happen like that, but you get the gist of the overall move. You get a super high risk reward by pinching your risk really tight and by magnifying fractal patterns against bigger patterns against macro patterns, all aligned in the same direction. Are you understanding the key concepts of what we're discussing here? If you say yes, then you have to hit the puppy licks button up front and drop us one comment to say, I get it, Franco, I get it. I know what you're saying. Thanks for helping, making me a better trader. And if that's not the case, just say, I get it. Okay, so there you go. So that's one. And don't forget, once that is triggered, the 65, that takes you back to your red zone, which I'll put back up for you over here. And now you are back down these levels, which was when gold was over 2,000 in 21, the beginning of 21. And that was very shortly after, don't forget, March 20, about 11 months before, you had the events that we've referred to. So that would have been around there, and you got bounced around. But the gold silver ratio didn't move too much. So that's 19 when the repo issue started, and then you had the blow off. That was March 20. Yeah, so the blow off is your events, and you could see that silver suffered disproportionately, and you had an all-time high, hence the capitulation. So now you have a red head and shoulder. Let's make this a red line rather than, I normally use just the light blue, but that is a red head and shoulder. We've drawn it in red, and that is now right shoulder, right shoulder. We've got our lefts on our rights, and I was on ladies left and ladies right there. Oh, I'm going to get in trouble for that one. Never mind, never mind. I love my ladies. I love my lady. If you're a lady following a YouTube channel, hit the like button and leave me a comment and tell me I'm a toxic male bastard. Okay, so the red neckline is 65, that one is 75, and that's down to 32.8. And as I suggest, the potential for overspill and blow off is vast. Every time you get an overreaction on a much bigger scale, like you did here, the likelihood is in the end you get a massive similarly scaled underreaction, which is why I still say people are underpricing the possibility. Doesn't mean I'm saying it will happen. Underpricing the possibility that at least for one moment in time you will trade a single digit differential in the gold silver ratio. That means going through 10 So it would be a spiller, an absolute thriller on the gold silver ratio. And those holding precious metals would do very well. By the way, pure gold link below. Go and book, delivered to your door. Platinum, silver, gold, you name it, all there for you, delivered in hand. I'm a customer. I will not ever endorse anything I don't use myself and that I'm not satisfied and got good service. Any signs of flakiness and I'm out, and it comes out of our links. So pure gold, beautiful. Look at this packaging. I just love it. I've got it out so many times. This cardboard box is fraying. It's getting mangy, the packaging now. But look at that, with it certificated. And look at that. I just love that. Come on. That's when you know this is real money and everything else is promissory notes, my friend. Go ahead, help yourself. If the time is coming. And by the way, don't wait for a triggering event like this. Good luck getting anything. Let me tell you, the delays and the leagues and lags on potentially, they are varying all the time. And just before a major run, you can be sure all the bankers and everybody with the insider information will be all over it. If you try do just-in-time entry in a physical purchase of precious metals and you are not seizing the opportunities now to already have some degree of position, you will be caught out at the moment you pull the trigger. You will not get delivery and you'll be part of a queue, take a line, you'll get something way down, you'll be quoted massive premiums, etc., etc. Pure gold give you a guaranteed buyback. Okay, so that's it on precious metals. Looking good. I think it goes against us for a bit on the gold silver ratio, but I've already highlighted that there could be that possibility of that demand destroying event. If we got a horrific one like a bank hack, that's falling in my opinion, and we go higher one more time. So, you know, I retain that possibility. It doesn't have to fall like anything. It doesn't have to. It could go just higher. If we don't, and we just get, everyone goes, oh, it's going to be a soft landing in the recession and all of this. Well, good luck. I don't know. I'm not buying that one, but let's say you get a little bit of a move up and then they're going to keep, they won't cut rates as much because everything's so hunky-dory, and there's still going to be fairly stubborn pricing power there. The inflation narrative keeps a little warmer, doesn't get killed by complete disinflation. Then that's actually going to be the scenario that works best for us as metals traders. That means the dollar won't get to be too strong. You'll have a small fiat trade for a while, a little bit of money going into bonds, but I don't think bonds will ever be where they once were at the peak of the COVID's 1984 lows. So that soft landing actually, or medium landing, is actually quite good for a small right shoulder, which is kind of what we're looking for. I think it could be a little bit harder, and the reset mindset in me says one of these days they're going to drop you into the UBI and flatten banks' accounts. So a Friday evening is when it'll be announced that your bank and your deposit scheme are not able to meet the commitments and a following bank has fallen. That could actually still be very powerful for gold, but it could also be very liquidating. I don't know what to explain, because that is hyper disinflationary. Money is dying. Cash will definitely be king. A lot of people will be running to cash for everyday transactions, but for balance sheets and assets, they should also be running in gold and silver. Okay, so yeah, pretty detailed, quite a bit there on the head and shoulders front, quite a lot to watch, you know where we stand on that. And as I've highlighted on the crosses, we gave you gold euro, we were broadly accurate on that. It's gone since then 680 to 755, hasn't finished going up there, by the way. I would also say there's two outcomes for the rising wedge. There's also the melt out the top outcome, which is what we've referred to as type 3 in our theory. So we have 3 type wedges, and you can have a good old look at that. It might go only to the splitter, a halfway mark, and then you might get more grinding. If that happens, it's a sign of loss of momentum. That increases the odds of that. You see how we come to conclusions subject to price behavior and a probability biases. We're swinging the probability meter that is sitting there. If we get a really firm risk move that is similarly bold like that to the other side, then we've had, you know, a number of really strong upward moves to the strong side. And if you have a drifting channel very similar to this, which was not too hectic, You can see this drifting channel here, and you can also see that it started to fail to get to the other side and start rounded bottom. So it started bending itself around like that and set up that squeezy for the little pop. So if we get that, if you get really strong and then you get lazy falling wedge, something like that, well, then I can tell you that's what's coming next for your gold versus your euro. And you can expect not very different for your gold pound, your gold JPY, and almost invariably your gold dollar too. All their charts slightly different. Okay, so you've heard it all. That's it. Book a call. You know what to do. Click on the link, speak to a non-salesman and community member. They'll tell you all about his experiences and show you exactly what you'll get. And we'll be glad to have you if you feel ready and you want to build wealth in reset times. This is what we're aiming to specialize: the building of and protecting of wealth in reset times. Okay, thanks guys. Catch you next time. All the best.